2 months sounds crazy to say you can go another 30%, but it's possible because that's what happens at the end of major secular bull markets is things get very steep, and investors get very ebullient and start chasing things in a way where they're afraid they're going to miss everything if they don't jump on today. We're not there yet. There's been a wall of worry that's kept this thing from getting so overbought or getting to a top and rolling over. Yeah, I part of my scenario that I've stated consistently through the last 6 or 7 years is that if in fact we are in the later stages of a secular bull market that's been going on for decades, that what we would see, and I said this, way back probably 2019 and 2020, certainly since then, I have stated that if you look at the legs to this bull as it moves along here, that the legs would get steeper and steeper. And that's what we're seeing.
Last week, chips lost trillions of dollars in days, then ripped back in the biggest semiconductor rally probably since 1999. And now peace headlines are pouring, gasoline all over it. Is this the final leg igniting right now on our screens, what you've been talking about?
I think it is. It doesn't mean it goes straight up here. It gapped up a couple days ago, so I can't say whether we go back and fill that or not. So I don't want people thinking, oh my God, I got to jump on, it's running away. But I do think we are in that last run to the top. We've been in a melt up, but I think that melt up's about to get steeper and what I call parabolic into the top.
You're calling, let me call it a top. Describe it. And what does the last week of a 44-year bull market look like on tape? I mean, are we in that right now?
I don't think so at all. I will never claim to be able to tell you what week it ends, or even when you're in it, that's the week it ends. I'll probably not be able to tell you to the month or even a couple months. But my take right now is that we are in a 44th anniversary of the 1982 bottom. So we started, in my opinion, a secular bull market back in August of 1982. It was driven, we were coming out of a major recession and the whole, Volcker era where rates were driven up and money supply was driven down to try to control inflation. It was high double digit. We turned the corner in August of 1982 and began this bull market. The Dow back then was 780. We're almost 55,000 today. So that's how far we've come in 44 years. And I believe we are in the last stage. That could last 2 months. That could last 4 or 5 months. But that's how close I think we are. Not a week, not 2 weeks. I raised my targets, and I've raised them several times, certainly since October 2022 when we started this cyclical bull after the bear in 22. I raised my target several times in that time. I'm now at 10,000 on the S&P. So I think we're going from wherever we are now, 7,750 or thereabouts, to 10,000 in the next several months. Could be, like I said, 2 months. It could be 4 or 5 months. Because I think it's going to be parabolic, that's why I can say we can run that far, that fast, meaning even 2 months sounds crazy to say you can go another 30%, but it's possible because that's what happens at the end of major secular bull markets is things get very steep. And investors get very ebullient and start chasing things in a way where they're afraid they're going to miss everything if they don't jump on today. We're not there yet. There's been a wall of worry that's kept this thing from getting so overbought or getting to a top and rolling over. If you just looking back, just using 2022, you could go back to the pandemic low of 2020 when the S&P bottomed out around 2,200. But just using October 2022, we came out of that at 3,500 or thereabouts on the S&P, and really all you heard for the next several months was this is a bear market rally. It might go to 4,000. Initially it was going to only go a few hundred points. Then it might go to 4,100. Then it might go to 4,500. Then it might go back to the old high of 4,800. But all of that time, institutional investors thought this was a bear market rally and was going to roll over and go to new lows, below 3,500, maybe below 3,000. It's only been in the last, I don't know, probably when we got up over 7,000, where the institutions started saying, hey, actually they started saying we're in a bull market when we went to new highs above 4,800, but they never thought it could go more than a few hundred points higher, and they've raised along the way. You're now seeing all of a sudden numbers like 8,000 out there. You didn't see that for the last year or more, and I've been at 9,000 and above for well over a year. So what I think you're seeing is the beginning of that wall of worry being brought down a little bit, or the skepticism starting to disappear. And what you're going to see in the next few months, I believe, is a full-blown shift from skepticism, one leg out the door, one foot out the door, to all in. This thing has legs and can go for a couple of years or more. And you're beginning to see even some of that rhetoric come out now.
David, your melt up, I would state, needed falling inflation and rates at the same time. Inflation stuck above 4%, and the Fed's leaning towards hikes. What fuels a parabola into tightening?
Well, I take issue with 4%. It's 4% on a very short-term basis, but the trend is still down. We came down from 9% in the last couple of years of the Biden administration. We came down to 2.5%. The war in Iran has pushed oil prices obviously up, and some other things, fertilizer prices and some other things. And so you did have a bump up to something like 3.5%, maybe not quite 4%. But if you look at some of the other indicators, other measures of inflation, like truflation, they've been down under 2% for this time, and they may be more accurate than the CPI or the PPI or the PCE index, even though the Fed looks at PCE more than any of them. So I would argue what I've said all along, and we could talk about wash down road, but I'm very gladdened by Warsh talking about the need for the Fed to look at trends, not month-to-month data. Trends are what matter, and the trend in inflation, in my opinion, is still down. Yes, we've had a counter-trend rally in inflation, if you will, but most of that is driven by Iran, by what's going on in Iran, and mostly by oil prices and gasoline prices. So as that evolves, if we really are going to see the strait open up here, you're going to see oil back into the 60s pretty quickly, and maybe below that. And that will go a long way to bringing inflation back into the twos. And ultimately, I'm calling for a global bust, as you know. In that global bust, I think we'll be looking at deflation. I think it's next year. We'll see. So I'm in a very contrary place, as I often am, in not worrying about inflation. I'm much more worried about deflation in the year or two ahead.
Do you feel that AI, theoretically technology, especially something that, let's go with once in a lifetime, that's only about 4 years old and advancing very quickly, that could lead to significant deflation?
Yeah, the deflation I'm mostly talking about is macro, as I say, macro driven. As I say, if you enter a recession that morphs into a bust, with inflation below 2%, which is where I think it will be when we enter that place, you're going to quickly go into deflation. And because a bust, just to simplify it, I can get more complicated in terms of what a bust is, but I'm calling for something worse than 2008-9, and in both financial crisis wise and economically certainly is bad. So if you go into that kind of a period for a year or more, you're looking at, and if you're going into it with inflation almost below 2%, it's a given it's going into negative territory. You can add on to that the longer term consequences of AI, which will enhance productivity and will help control inflation. I do believe with my whole scenario about how, what happens in a bust and what happens to central banks, how they respond to a bust, how the Treasury responds to a bust. When you go through that scenario, I do believe it will turn into a hyperinflationary environment on the other side of the bust. And so, yeah, AI will help ameliorate that to some degree, but boy, macro will trump all of that, in my opinion. No pun intended.
Oh, we have much to, well, overused term, but unpack there. Uh, every sell-off since, let's say, COVID 2020, you called a fake out. And last week, the tape proved you right again, like in 5 trading days. But here's the harder question. When recoveries get this violent, this fast, isn't that itself like the top signal?
Yeah, I part of my scenario that I've stated consistently through the last 6 or 7 years is that if in fact we are in the later stages of a secular bull market that's been going on for decades, that what we would see, and I said this, way back probably 2019 and 2020, certainly since then, I have stated that if you look at the legs to this bull as it moves along here, that the legs would get steeper and steeper. And that's what we're seeing. If you go back, just look at since 2022, each of the successive legs, and then I don't think I called the corrections fake outs. I'd say investors got faked out, for instance, in silver when they went for the, or they got bearish at the bottom. I called those fake outs. But the actual corrections, I think, are a normal part of the process. They're consolidations that build the wall of worry back up and allow you to have fuel for the next advance. But my whole scenario has been that we would steepen into the top, that each leg would get steeper. And if you just look, like I said, just look at the last 4 years, you would see that each of the successive legs, 2022 to October 23, October 23 to October 24, October 24 to the April swoon on the announcement of tariffs, the big rise out of that April swoon into the October, I think it was October 25 top, and then we've had since that we've had successive rallies that get steeper as we go. So we're at the point now where as it steepens here, it's going to be parabolic. And I would even argue that the 2-month consolidation we saw in June and July, if you look at it on a monthly basis, we may have started the parabolic, when the rally started. I guess it was the end of April. That steep rise out of the low, the war, the Iran war lows in the spring that ran to the beginning of June. We didn't really lose that parabolic or that rise in the consolidation. It was a pretty much it. You did in some things, and certainly in some of the AI stocks, but in terms of the S&P and if you look at it on a monthly basis, you could argue that you really didn't violate the beginnings of a parabolic. It's semantics. I don't really care whether this is a new leg starting in at the beginning of August, or whether this is a continuation of things that started back in April. Either way, it's going to steepen from here.